Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So this week, I'm joined with Jeff Bierman. How you doing today, Jeff?
I'm doing well today, Kirk, but the market doesn't seem to be agreeing with the way I'm feeling and smiling.
Well, for those of you who are listening, it's the first trading day of 2023 and did not start the year that well. So that's what Jeff is referring to. But Jeff, I really wanted to get you on the show. I think, this is a great time to get some perspective on the markets. 2022 just ended and we're starting the new year right. So, can you tell us a little bit about your background, kind of what you've done up to this point and what you're doing now?
Yeah, I'm old school. I'm getting more grayer as the year goes on, not just from being a professor, but watching the markets. I'm a professor of finance at Loyola University of Chicago. I teach at the undergrad, the MBA, and the executive MBA level. I'm also an adjunct professor at DePaul University here in Chicago. So I kind of have to split time between the two universities and other things afoot. You can see a little in the corner, TheoTrade. I'm the chief market technician at TheoTrade, which is an online resource for helping professional and retail traders make sense of the market, which is a chore in and of itself day in and day out. And I also have my own site called thequantguy.com, where I produce daily videos and a special weekend rant, which is, unless you've never seen it before, it's an uncensored, unscripted, and unedited stream of consciousness 45-minute rant about what delights me about markets and what angers me about markets and what confuses me about markets, Kirk, because I don't have all the answers all the time and everybody wants answers, but some days you don't have them. So I'm pretty much grounded in that finance background. So there you have it.
Nice. Well, I think everyone's looking for answers right now. And I always find it humorous this time of year as people go through and give their predictions and everyone's got predictions. I'm not sure how many of them are actually accurate, but people want to hear predictions.
Well, I got to tell you that I read a stat this morning that of the predictions that the managers made last year for 2022, Kirk, 97% were not even within 1,000 points of their prediction on the S&P. So at the risk of not making myself a fool, is it okay if I step back from making too much of a prediction today?
Yeah, my predictions is everybody else's predictions are going to stink. That's my prediction for the year. So, but let's just kind of dive right in, because I think, predictions aside, I mean, obviously none of us can tell the future unless you've got some skill. You're not advertising. You don't know the future, but there obviously we can follow certain themes, right? We don't know if what's going to happen in Russia, Ukraine. We don't know what's going to happen with the S&P or the bond market. We might have our theories, but we don't know for sure. But there are some themes. So maybe you can kind of talk to us a little bit, some of the themes that you're seeing, good and bad for the coming year. Okay,
so let's talk about last year, Kirk. Last year was what I call the year of reprogramming. Post 2010, we spent about 10 years with a couple of hiccups in between, COVID, and the Fed raising rates in 2018, and then he rescinds and calls an audible at the line of scrimmage and pulls it out, and the market just keeps going. We had 10 phenomenal years. Even when we had a down year, it didn't even feel like a down year because it was negligible, right? So there was this conditioning going on, like a Pavlovian dog. But I call there's an experiment years ago called little baby conditioning. So there's a Pavlov, which is the dog, and Albert, which is the human. People were conditioned to think like a normal market is, I wake up and I buy. And when it goes down, I buy. And when it goes up, I buy. And when it does nothing, I buy. And people got really comfortable with the Fed, charts. I call it the easy route. They were programmed to think that, this is, it just goes up, it goes up. And all of a sudden, last year hit us. And all of a sudden, everybody's mind changes. It's not like you're racing a computer, but people are reconfiguring all their expectations. This year, I call it the year not of reprogramming, but recalibrating, which means everybody's been hit with the shock and awe, Kirk. They got it. Oh my God, crypto. Oh my goodness, SPACs. Oh my goodness, Tesla. Everybody's now in a realism mode, which is great. But the thing is, you have to understand is, the business was founded 200 years ago and beyond as a pricing mechanism. It's not a video game. It's not Xbox, okay? It's not. It's literally like you actually have to, I know, Kirk, this sounds weird to you, but you really got to do research. I'm not trying to be facetious. And all of a sudden, managers are waking up going, I can't live on the model I lived on, which is track the Fed, track the charts, track the sectors, and chase. That window's closed. It may reopen at some point, but now it's like, okay, now I got to really sit down and number crunch. That's what's happening now. And that's why the market's having fits and starts. You got interest rates, no longer the Fed put. Now you've got compression of margins. You've got layoffs coming. You've got all these headwinds that are people like, oh, you know, that free ride going up the hill is not there anymore. So now people are thinking, okay, I've got to retap my skill set. So I call this the recalibration year. Now I know it's only day one, but the fact of the matter is, this is the healthiest thing that could ever happen to the market. To recalibrate all of our expectations is going to put us in a good place. So I call it pain now, Kirk, prosperity later. This is going to set the stage eventually when we bottom out for bull market for years to come, because people are not going to live in that Fed-fueled fantasy world of just chasing charts and chasing themes. So that's how I'm kicking it off so far. That's like the good part. So.
No, I appreciate that. I think, I think you and I kind of think alike in this way. I think there's one of the challenges I've seen is, people are accustomed to certain things, growth only, no value. The stock market always goes up. And, that conditioning that you're talking about is what gets people into trouble, right? Is that you have these paradigm shifts in the market that we haven't seen, frankly, this big paradigm shift we haven't seen in 40 years. Interest rates went down for 40 years and bonds were safe, right? They're no longer safe if you own bonds this past year.
Right.
So I think, I guess the real question is, so we have this new kind of paradigm that's going on, which, as you're kind of accurately putting, people have to actually pay attention and do their work. But because people have atrophied their skills for so long, especially active managers, right? Because they could just buy the SPY in their fund and just ride along the coattails because, hey, everyone else is doing it. So now that we're in this, in a different paradigm where people have to do their work, how long do you think it's going to be before people realize this? That's been my biggest question, because eventually people realize it, but is it going to be this year? Is it going to be 5-10 years later? Like, when are people going to wake up to this?
That's a really great question. I'll tell you why, because, there used to be that graphic called the 13 stages of a psychological market cycle, the peak, the coming down, the denial, the anxiety, the bargaining, the acceptance, the capitulation. I know you've seen, Kirk, I know you've seen this. Everybody has seen this.
Oh, we'll put it up on the show.
We'll put it up at some point if somebody can pull the graphic up. But here's the way I'm looking at it. We're not in a situation where the market is going to fall out of bed to 1100. That's not where we are. Like that diagram works when the market's set. You think it's going to go from 4,800 to 1,800 and lose 2/3 and do one of those Fibonacci retracement 61.8s. We're not even close to that. And the reason being is because the valuations on so many sectors are compelling. Financials, not cheap, but not expensive. Tech, not as expensive as it used to be, but still a little expensive. Retail in sectors, dirt cheap. There are certain sectors which have already bottomed out, and there are certain sectors which are still in a bubble. So you have to go through that period of readjusting where you have to crush the parabolic and you have to take a dive in the water and dip your nose and hold your nose and buy value. So how long will this take? I don't know, but I can tell you this. When all sectors, every sector, and there's 11 in the S&P, Kirk, 11, financials, energy, retail, consumer staples, information technology, there's 11 of them, REITs, when they all get to a multiple below 12, even to 10, you're at the bottom of a market period. You're there. It's been proven all throughout history. The problem is some sectors are trading at 8 to 10 times earnings, like financials, like Goldman trades at 10 times earnings. And you've got Wells Fargo trading at 10 times. So those stocks are fair value. Then you go to semis. Semis are trading at Intel, 7 times earnings, Kirk. Micron, 8. but nobody wants them because they have to figure out how to fix the inventory problem. But the point is the market looks ahead. It doesn't look behind. So it's already pricing in the bottom of the semis. It may take another few months, but there are certain sectors that have to play catch down to what other sectors have already done. So the question you're asking me can't be answered by time. It's not a function of time, Kirk. It's a function of math. When the math starts to make sense fundamentally, we'll get there. And the problem is like Coca-Cola, 26 times earnings, ridiculous. Pepsi, 28 times earnings. First Solar, 72 times. When these stocks come back to earth and we start to get across the board where the valuations are compelling, then there's the second part. The second part is you have to turn headwinds into tailwinds. All we have is headwinds now. When's the Fed going to stop raising rates? Well, they paused, but they haven't pivoted. When will inflation top tick and get below the Fed's mandate of 2.5? We don't know. So I can't stand when people put the pressure on me. Pardon me, Kirk, not I'm mad at you, but I can't pick time. I just look at it and go, when numbers come and adjust into pockets or prisms where everything's aligned, then the market's like, we've arrived. Now let's start to look forward instead of backward. Right now, the market's got too many headwinds and not enough tailwinds. In a bear market, I'll end this. Bear markets, the growth doesn't work. Value works. And that's where I'm making all my bets right now is in value. Even growth stocks that have become value stocks is where I'm placing my bets. That's the best I can offer you.
No, I like your perspective. I mean, I think about value stocks and people have ignored them for basically close to 20 years. I know there were a handful of years in there in the early 2000s where value did okay, but pretty much people have ignored it and just gone strict growth from pretty much the last, not 20 years, maybe the last 15 years. And I think that, the challenge that I find is, as we were talking about, is that, people are conditioned to buy growth on the dip. People are conditioned. They say, oh, well, the NASDAQ's down 30% and some of my stocks are down 50. What a great time to buy. Because that's all people have been accustomed to. So, I ask because I think, because of that conditioning, at some point, people wake up, and maybe that's where the bottom is, as you said, is when people finally wake up and say, oh, well, maybe I should switch to value, and then it'll be too late. So let me ask you this, because, we can talk about when the right time to buy is, but metrics are really important. So for the past 15 years, people have just bought the dips, as you said, or they're buying the Fed put or whatever the metrics people are using to buy. But now that those are kind of gone. So what are good metrics to look at? What do you look at for valuation and say, hey, these are really a good place to start buying?
Well, it doesn't depend just upon absolute valuation, but relative valuation. So every sector is not created equal. I mean, there's going to be more growth in the long run on tech than Goodyear Tire and Rubber. So what I do is I divide and conquer. I set a metric prism where certain sectors belong here and could expand here versus others. So the message I'm communicating to your listeners is simply this. The indexing works. It does. But this is not the type of market where indexers thrive. This is a stock pickers market, or let's just call it a sector pickers market versus a stock pickers market. That's the first thing I want to throw out. So indexing works fantastic in a bear market. It actually outperforms an active manager. But in a bear market, indexing fails you. This is where listeners need to say, listen, owning the S&P may not be the right choice. Maybe I need to divert my funds into an ETF, oil, semiconductor ETF, a bank ETF, a financial broad specter ETF like the XLF that's got banks, it's got insurance, it's got reinsurance, it's got broker dealers, something like that. So again, not an absolute number, but a relative. That's the first thing. The second is I'm looking for yield. And I don't mean in stocks, Kirk, please. I'm looking for yield in bonds. I'm looking out there over the horizon saying, let me think about this for a second. I could earn 5% in a stock. That standard deviation is twice that of a bond, which is the risk metric, or I could get 4% in a bond for half the metric. Well, they've got this thing called the mean variance criterion. It simply means get the highest return at the most manageable risk measurement. So when people reach out and say, oh, I'm going to buy stocks, okay, you're not thinking this clearly. Buying stocks comes with risk. There's risk is always before reward. So start to think about, well, how can I redivide my assets, my financial wherewithal into getting the better bang for your buck? For me, I've moved towards bonds. I'm getting 4 and 5% in some areas, and I can't even get that in a stock. And even if I got that into a stock, okay, I could easily lose a 4% yield if the stock dropped 10% in a day. So you have to be careful, not just buying any stock that yields a dividend, but one that has a very low valuation metric relative to its peers. It's got a lot of upside and it's got good cash flow. So if you're asking me a metric, dividends, cash flow. I'm really into like if there's no cash flow, Kirk, I'm not even looking at the thing, regardless of the liquidity or the sector. It's you got to cash flow me, because you saw what happened to Peloton. You saw what happened to all these EV companies. They're all melting out of the way. And people like sending me emails. Why? They don't have any cash flow. They're burning. So cash flow, dividend yield, and maybe like a price earnings multiple or a PEG ratio. Just keep it simple. Don't try to go over your skis here. It's not good. Less is actually more in this business. That's my approach to this.
Yeah, no, I appreciate that. I think that's kind of a lost art, looking at cash flow, because people were focused on growth, right? Especially with tech stocks. It wasn't about cash flow. It was about, how can I grow my network, grow my subscriber base, grow all these things. And I remember sitting in a meeting with a private equity guy, and he was telling me that somebody brought him a deal. It was a great cash flowing company. It was a kind of a brick and mortar. It was like razor blades or something. And it was a great cash flowing company. And he said, we don't take that. We want a company that's losing money. We want a company that's spending all the cash flow on marketing and none of it on that. And it's like, it's silly, but that's what they looked for. So I guess the question I would ask is, so I love the fact that you're talking about cash flow. I think that's very important. But I guess from a bigger picture, right? If I look at the last 100 years, there are times where, as you're putting, value is in favor and growth is not. But I think the overall market kind of, it has I don't want to say it has a value in itself, but there's a certain level that you can look at the market and say, all right, things are overly cheap now, or things are overly expensive. Do you look at things in a macro perspective, or are you just looking on a individual stock perspective?
I'm not Warren Buffett. I'm not a micro bottom up guy. I'm a top down guy. So I'm looking at across the board, different countries. I look at things like interest rates across different countries, inflation across countries. Like, for instance, the inflation rate here, people say, oh my God, we've gone from an 8.5 handle to a 7.1. Well, 7.1 is still out of control, but at least it's less than Europe, where I talk to clients and it's like, well, it's 10% over here across the pond in London. So yes, I do look at things on a macro level, on a region by region level. That's the top-down approach. I also look at monetary policy. I'm trying to figure out, well, what does it stand for? What are the rates in Europe versus the rates in Singapore, Hong Kong versus our rates? Like, is there room for them to go that much higher versus us? Because if they could take their rates to 6 or 7 and the Fed says, well, we're going to stop at 5.25, that's a big deal to me. Every time you raise rates 250 basis points, which is, 1/4 of 1%, it takes about 300 points out of the S&P. It's like a mathematical model. And across the board, when you look at other countries, ETFs, Brazil, Japan, Singapore, when they raise their rates, Kirk, it takes way more. It takes not just 2 to 3% out of their pricing index. It takes 3 to 5%. So it's got a relative risk embedded in it. So as a bottom-up person, yeah, I look at the US, but I'm also exploring other regions of the world where if they're cash flowing, paying the dividend, their metric makes sense, I will do it. Plus, I'm also looking for a non-correlation factor. I'm trying to see where, well, if their market's going up and ours is going down, and they're not correlated, they're inversely correlated, there's an opportunity for a hedge in my place, even if the hedge, Kirk, is only for a year. So I'm spread out. I'm open-minded. I'm not just, myopic and tunnel vision going US or bust, USA, not at all. I'm looking at foreign markets and where I can get the best bang for my buck, but I'm also acutely aware of what their monetary policy is, what their interest rate term structure is. all that goes into my decision. I'm just not as smart as Warren Buffett, to be honest with you. I have a lot of respect for him. He makes mistakes, but he's a bottom up guy. And I'm not, that's not the way I've run my portfolios in the past. So I have his respect, but I'm more macro than micro.
So let me ask you this, because one of the things I've noticed in the last 20 years, I'd say it started probably in the early 2000s and got progressively worse in 2008, are the correlations. So you're looking at correlations both in the US and globally. And one thing I noticed is when you have these mini contagions, 2008 is one of them. You had 2017, 2020. I think we've had probably like 5 in the last 12 years. And so when you see these contagions, everything correlates. So how do you manage that when you have these, one-off events that happen almost every few years, and they cause a contagion? So the correlations you're trying to create to diversify fail. So how do you hedge against that, and how do you look at those in general?
Well, the first thing is, when most managers take that approach, they're fully invested. There's no, if there is any cash, it's for redemption. That's it. Like, they're not going to sit there and go, hey, we're in 10% cash. That does not happen. The idea of Kirk, hey, there's cash on the sidelines. Nonsense. There's no cash. Their cash is moving. It's finding a home somewhere all the time. So if they're fully invested, that pressurizes them to have to make sort of like, it pinholes them. It pigeonholes them into a corner. I am not fully invested all the time. There are times when it's a bull market, I'm like, well, I got to be fully invested in this. And there are times when I'm in a bear market where I'm uncertain, like now. And there are times when I have pockets right now. I have pockets in my accounts of 20%, 25% cash. Well, for most managers, that is not that's just not permissible. It's in their bylaws. They cannot do this. It's like a law. It's a mandate. For me, I'm flexible because I run my own money. I don't run other people's money. I run mine. So it's okay to be in a money market and leave it there, because it's better to be safe than sorry. That's the first thing. So you don't have to be fully invested. That's the first way you can approach this. The second is, I run scans that I build looking for what I call correlations, not by same asset class, but by differing asset classes. So I'm going to look at what crypto's doing. I'm going to look at what oil's doing. I'm going to look at what certain commodities are doing. I'm going to look at what fixed income are doing, and then spread out the fixed income. Is it corporates? Is it municipals? Is it treasuries, governments? And I'm going to look and see what the asset mix correlation is, as opposed to saying, well, I'm going to trade stocks based upon only stocks based upon correlation factors. I don't do that. I try to spread the risk out and say to myself, if I'm going to make a mistake here, I better have some cash in order to back me up. So if you're not fully invested, that's okay, number one. And number two is that don't just bury yourself in stocks. People have to understand, stocks has been the go-to play. I like the word TINA, Kirk. TINA, there is no alternative. Yeah, I heard that a million times on TV. There is an alternative. The idea is there was no alternative because you were conditioned to think that. You have to start thinking outside the box and saying, hey, if my model's been 70-30 stocks, bonds, maybe it should be 60, 50, 30, 20, where you start to keep more cash on hand in anticipation of what could be opportunities by non-correlations, or just by a market that falls further. But if you're in a professional situation, I understand they're handcuffed. So it's all based upon, how you feel about comfort about money you have on hand. So.
Yeah, no, that makes sense. So, cash is obviously one way to hedge portfolios. Any other ways you use? I know we talked earlier in the show about options, but what are some ways that people can also hedge portfolios?
Yeah, I'm really all about puts and calls. So when I have certain stocks that have run a certain distance, like I'd say, oh, I've made 20 or 30% over 6 months. I don't want to sell it because I'm just going to eat the tax right there. I don't want to. So what do? Well, I just sell the call. This call lowers my cost basis. It generates me income. And I'm also rooting for the stock to pull back, because if the stock pulls back, my call option protects me, my covered call. And then I get a chance perhaps to add more of the stock at a lower price. So I do a lot of call options, call spreads, and just covered calls. The other side of this is when I have a stock that's going a long way, because I've had some stocks go, I own the 3 or 4 oil stocks. I'm like, well, if I got to pay the tax on this, there goes 50% of my profits. I just looked and said, let's just buy puts. Let's just ladder out some puts for 8 to 12 weeks. If the stocks go down, that's okay. I'm protected by the married put. And if I have to give the stock away at some point, I will, because I'll be willing to buy it back. So I'm all about puts and I'm all about calls, but it depends upon the beta and the risk parameters around that given stock and that sector. And I wouldn't say I'm 100% hedged at this point, but I do have a fair amount of puts and calls working right now that have literally saved my life compared to where we were even 2 months ago. So yeah, I'm all about options. And occasionally I do a little bit of futures. I will actually not ETFs, Kirk, not because I don't want to deal with the theta decay. Not like buying the SSO or an inverse ETF. I don't go down that path at all. I just short the futures product straight out and say, hey, small one hedge, trade small. You'll take the hit on the stock, but you'll still have some sort of hedge out there that mitigates some of the risk, but never mitigating all the risk, which is just not possible in the way I set things up. So yeah, I definitely hedge.
So just out of curiosity, why futures instead of an inverse ETF? What are the advantages, disadvantages there?
It's the way they're structured. I don't like the way they're structured. I don't like the way, it's not just the management fee part about it, but sometimes there's a departure from net asset value that creates, what I call like the ARB free boxes of the algorithms come into the market and go, oh my God, there's a mispricing. And that happens because they're constructed of a certain concentration in a given position. So they already have algorithms and artificial boxes out there that can see this. And then you have that theta decay portion of it where when they're issuing more or they're splitting or they're reconstituting, sometimes you get eaten alive by an arbitrage or a mispricing play. And I'm just not about leveraged ETFs because time and again, they've proven that they're only good for intraday or day-to-day type of hedging vehicles, but not long-term. I mean, you can pull up tons of them and go, hey, this one was at 6,000. How is it down to 20? This must be a misprint. It's not. It's split so many times over and over and then just died back down from theta decay, which is the whittling down of the time value, that it's not really worth the time. What I suggest is do your homework. Don't rely upon me. Go look at the ETF. Go look at the way it's constructed. Go look at the vendor. Go look at the sponsor. They have all the information. It's public. Kirk, it's publicly available. You can get it anywhere. You can get it from Morningstar. You can get it from Microsoft, Yahoo. Go look through and see how they're constructed. What are the fees? What are they have a decay factor? What are the R squareds? And you can see it and decide for yourself. I don't want to get too academic here, but that's the path I would go. That's why I don't like them.
Okay, no, that makes a lot of sense. I think you and I agree on that on the leverage side. So, how about the Fed? I mean, the Fed has been a really important part of the conversation for the last 20 plus years, and I kind of feel like people stopped paying attention. They just start focusing on the Fed and they let the Fed make the decisions for them. And people aren't actively thinking anymore. They're just saying, oh, what's the Fed doing? And let me just follow that. So now that the Fed is kind of, I don't want to say taking a back seat because they're not, but how do you kind of manage the Fed part of the equation when you're looking at investing?
Well, when the Fed was created way back in the early 1900s, it was a stopgap measure. It was an afterthought. It was, okay, we're just here to back you up if things go haywire, if things don't go haywire very often. The Fed was supposed to be not seen and not heard, but there just in case. Cut to the chase 100 years later. The Fed basically is now running the market. It's micromanaging the market because every decision managers are making is based upon the next move, like a chess match, or like they're being like Sherlock Holmes. What's the next move so we can get ahead of the Fed and start buying or selling? That's not the approach I would take were I you. I think that window of 10 to 15 years when it was the handoff. I call it the handoff. Bernanke starts it. Then he pitches it to Yellen. Then they pitch it over to Jerome Powell. That's what they've done. And so they've followed that same path, that same model, that same paradigm. And it's lifted up the market for 10 years. But what it's done is it's created an aura of invincibility. It's created an aura like, oh, don't worry about me. I got the Fed. They'll cover my back. They're my insurance company. They're my put option. The way I feel about it now is the last year has not completely eliminated that thought process, but I think it's reconditioned people to think like, okay, from now on, I will pay attention to the Fed, but I can't rely upon the Fed for every single sole decision I make to buy or sell a security at any given point. So I would prefer the Fed to be more in the background, but that doesn't seem to happen. I think the Fed is micromanaging the market. I think it needed to in 2020. I think without Powell stepping in there, Kirk, this would have been a nightmare. I think he did the right thing, but eventually he overplayed his hand, and then people started like leaning on him as if he was some type of like, liquidity, an endless liquidity provider. What I would do is this. I would simply say, one eye on the Fed, one eye on fundamentals, and one eye on the politics of government, meaning monetary policy outside of the Fed, fiscal policy by the Biden administration. Don't get pigeonholed into living and dying off the Fed's movements. Start to diversify and balance out your thinking. Don't eliminate them. Don't push them underneath the rug, but look at them more or less as they're there if you need them, but don't rely upon them to create your future prosperity and wealth. That's the hope that I'm going to take over the next 2 to 5 years.
But I would say, this is always the philosophical debate, right? Is the Fed is a part of the conversation. They're a part of the markets. And everyone's kind of built into their calculus that the Fed is going to be a part of it. You can't just kind of remove them. No, right? There's really no way to remove them, and I don't see how it even goes back in the other direction unless they let the markets fail. Granted, there is no market on the planet that is not manipulated by some shape or form, some entity. So it's not as if that's not happening in other countries. It's some case like Japan, it's happening more. But I would think it's kind of hard to disconnect that, given all of the interrelations of markets and the fact that they could easily melt down given the fragility of them.
They can, but you have to understand this, is that the higher you go, the farther you fall.
Right.
If we're at 1100, we don't really need the Fed. If we're at 2000, we might probably need the Fed. You see what I'm saying? But when you're at 4000, you need the Fed, okay? That's what I'm trying to tell you, from falling from 48 down to 2000. So the problem is the market outgrew itself too fast, too soon, and the Fed overplayed its hand. So no, you're never going to get rid of them. I don't want to get rid of them. I think they're a necessary backstop program. It's just more or less that you have to think about this. The Fed only sets the overnight lending rate. They're the discount window. Who sets the market, the interest rate markets on corporates? The investors, you and I do. It's the supply and demand curve. Who sets it on munis? We do, the consumer supply demand curve. So the Fed sets some type of mandate at the lowest, shortest level, which is the overnight lending rate, and everything seems to key off that. So at some point, I think that investors are going to realize that the Fed is important, but the Fed is not the only answer. You have to answer to something else. And to me, that something else is fundamentals. You have to make decisions based upon how you would value certain assets and not look to the Fed to say, well, the Fed is going to protect my assets all the time. There's a time when they'll cut rates or they'll do certain things and the market will do its own thing because there's irrational behavior and you can't stop it. So if you think the Fed's out there and the Fed is doing something rational, even a rational decision by the Fed can lead to an irrational behavior by the market. So I say let the markets do what they want. Just don't if you're running a model, your model shouldn't be all driven by whatever the Fed does is what we do. That's groupthink that gets you dangerous. I've learned a long time ago from my father and my grandmother, the best investors, God rest their soul. They said, when everybody's on the same side of the market, something's wrong. You need diversification. You need an opposing opinion in order to balance things out. And what people have done is they've always associated the Fed as a buy trigger. Fed talks, I buy. Fed cuts, I buy. Fed raises, I buy. You have to kind of reprogram and divorce yourself, which is why I said last year was reprogramming, this year is recalibrating. People are going to have to start to realize if the market goes down to 3,200, what's the Fed going to do at this point? You're going to rely upon the Fed because they're not going to cut rates, Kirk, unless one thing happens. One thing has to happen. You got to get you got to get the inflation below a 4 handle. That's how they'll do it. So rely upon yourself more than Jerome Powell is what I would say.
So I want to kind of pick up as we kind of wrap it up here in the interest of time. I want to end it with this question. You mentioned that you're trying to get inflation below 4%. So where do you see inflation in 2023? And, and let's get into why 4%.
Well, the mandate the Fed laid down is 2%. And then they bent, then they twisted. Okay, 2.5, and that's bad. Okay, because 2.5 means we can grow sustainably. That's how the model works. At 2%, we can actually grow in a even statistical linear regression model trendline pattern at 2%. We can do it. It's been proven. Now, it's at 7%. Monetary policy takes 9 months to filter into the economy. 9 months. Fiscal policy takes 6 months. Monetary takes about 9 to 12 months. We started in April. So starting this January, it's really going to take hold. You're really going to see, the fruits of the planting. Inflation goes up like a volcano. That's what we learned. But it comes down like a feather. To put the genie back in the bottle, I'm thinking the Fed is thinking this. If we could just get it down 0.5% to 1% on a quarterly basis, which is manageable, 7 to 6, 6 to 5, 5 to 4, okay? That would leave us somewhere around September or August. The Fed is going to be feeling a lot better. Its work is not done, but they'll be feeling like, okay, it's finally paying off. So I think not only do you and I and all investors have to recondition themselves about expectations about earnings and markets, but the Fed itself has to recondition itself about how its expectation is to bring down the inflation rate, the CPI and the PPI. So I think maybe sometime later this year, third, fourth quarter, we start to see it get down to a 4 or 5 handle. But to get it to 2, the only way to do that is to raise rates that much further. And that's just going to take the S&P down even more. So the Fed has mandated a 5 1/4 top and a 5, 4 to 5 even, where it mean like not a best case scenario, but a base case scenario that they may have to do it 1 or 2 more times just once. If they do that, I think by this time next year, the market will be in a lot better place. Not necessarily by where the S&P is in terms of its number, like 32, 3,800, just where are we in terms of getting tailwinds, turning the headwinds into tailwinds and saying, we've got it to a manageable level. Now we can turn this thing out, start to pivot and come down and get this thing going up. So I'm giving it maybe 9 months to a year before we start to see the fruits of his planting of the seeds of raising rates.
So actually one quick follow-up question. This has been thrown out a bunch of times and I haven't sat down and done the research on it. So I'm just curious if you have, but that 2% target that they talk about, a lot of people have suggested that they just pulled that out of thin air because that is where we were at the time. And, we had a low inflation environment. I would argue it's even deflationary, depending on how you calculate it. But, for like the last 20 years, there was a lack of inflation and they just kind of pulled that number out of thin air because it made sense at the time. I don't know if that's historically significant. If you go back 100 years, that 2% seems a bit, let's just say a bit optimistic. Considering inflation's been a lot higher over the last 100 years. So I don't know if you have any thoughts on that or any insight.
I do actually. I read the monetary white papers to see what it used to be and where we are now. If you don't study history, you're doomed to repeat it, right?
Yep.
It turns out that if you actually look at interest rates between 2000 and 2020, this is going to shock a lot of people listening to this. The average was about 4.23 to 4.3%. Weighted average over that 20 period. So there was a time when we were at 6, right? And then the Fed's like, well, let's just drive this down to 0, which really skewed the figures. But your point is so well taken, Kirk. I can't believe it. 4 is actually like a historical norm. What they're doing is, and this is the way I think the way they're calibrating this, and this is the professor and me coming out on this. The cost of capital is reflected in interest rates. So if you look at the interest rates as saying, well, it's 3%. Well, that's a proxy for inflation, as in a 3% rise in inflation, meaning $1 today is worth 97 cents next year, right? But what the Fed's doing is they're saying, well, the historical yield on the S&P for 100 years was close to really 3.5 to 4%. Then from 1950 to the year 2000, when tech stocks took off, the yield on the S&P dividend started coming down to about 2.25%. So the yield on the S&P is an alternative like proxy for the cost of capital, like lending money. Because if you can earn 2% yield, it's like a lending type of thing. If I can get 2% dividend, it's like earning 2% on a demand deposit at a bank for lending, right? Like a spread. So 2 and to 3% became this acceptable number. And then what they do is they run these linear regression models and they would say, hey, if we could keep it 2%, could we keep this sustainable? And the answer was, yes, you could keep it sustainable, but only for so long. Because at some point, that 2% has to actually overshoot maybe to 4% for maybe a year and then settle back in at 2%. So 2% became a commonly accepted number to 2.5%, but it's not just random. It's actually pulled out from the dividend yield on the S&P, and it's also pulled out from the historical yield on the bonds from 2000 to 2020, and then also from bonds from like the 1900s all the way to like 1975. So they've mixed and matched numbers, and they found out that this 2 to 2.5%, almost in a weird obtuse way, it mimics the S&P yield. What is the S&P yield right now? About 2.25%. So if we can get the S&P down to 3,000, that would bump up the yield to 3.75%, and that would start to realign the interest rates down to 3.75. So when the yield on the S&P and the yield on bonds are the same, now you got a market that's at fair value and fairly priced that can actually take off and run again. That's the logic that I came up with when I read all the white papers and put it all together.
No, it's very interesting. I appreciate that perspective. I think, looking at history is really helpful in understanding the future. As you said, there was a great book I read by Edward Chancellor, The Price of Time, which was a great look at history of interest rates. And so, yeah, I think the more you know about history, the more you're going to know about, what's happening, especially the 70s. I wish there was more written about the 70s, frankly, because I think there's so many there's so many similarities to it that to where we are now that I think people would really benefit from that.
Kind of like the Nifty 50. Remember that?
Yeah. Maybe not mimicking that.
Well, not like that.
Oh yeah, the good old days.
Oh yeah.
Well, Jeff, I really appreciate you coming on the show. I know in the interest of time, we got to wrap it up here, but where can people find more about you?
First things first, TheoTrade, www.theotrade over my shoulder here on this side, www.theotrade.com. Take a look into it. There's what I call there's not what I call like necessarily a free trial, but go through the site and look how incredibly in depth it is. It's one of the greatest resource platforms that you could ever imagine on any subject matter, whether it's economics, bonds, futures, stocks, options. It's insanely deep, and the instructors and lecturers, they're in your league, Kirk. They're like right alongside you in terms of knowing how to deliver and explain and turn complex subjects into simplicity. That's the first place. The second is I have my own site called The Quant Guy. It's called www.thequantguy.com. It's a no holds barred type of thing. I don't have a producer or a shot caller or a compliance department that has, puts the kibosh on me. I try to keep everything only business. There's no religion. There's no politics. I only stick on business. I'm a numbers geek. And The Quant Guy, and you'll find there's a depth of resources about stocks, bonds, futures, crypto, educational, and the weekend rant is what it's award winning. People love the weekend rant when I just go off about what angers and what delights me. And then the last is you can always, if you're ever in Chicago and you're around Loyola or DePaul, swing by. I teach like a ridiculous amount of classes all throughout the year. And maybe one day you might get into grad school or get into an extension program and have the honor of teaching you. So that's kind of the places you can find me.
Awesome. Well, Jeff, I really appreciate you coming on the show. We'll definitely be back in the future. I know this coming year is going to confuse a lot of people, and it's always good to find people that can help put that into perspective. So thank you again for joining us on Money Tree Investing Podcast.
All right, take care.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is, The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Jeff Bierman. Really appreciate him coming on the show. That was a lot. That was a lot of deep and a plethora of information. Pulling out my thesaurus today. So as we get into the panel portion of the show, we have our very own Barb Friedberg. Hey, Barb.
Good morning. Happy New Year.
Happy New Year to you too. Glad to have you back. And we also have our very own Megan Gorman. Hey, Megan.
Hi, Happy New Year. How's everybody doing?
Happy New Year. Just it's a good start to the year. Nothing's blown up and it's been raining for 3 days, but I'm looking at that as a sign that things can only get better.
Exactly.
So let's just dive right in. So Megan, what were some of your takeaways from the interview with Jeff?
Yeah, I mean, first of all, I thought it was a great interview, a lot to dig into. And he talked a lot about recalibrating and how to really be thinking about a portfolio. And when I was listening to it, obviously the markets have been coming down since November of 2021. So now we're in month 14 of it. It feels exhausting at this point. And looking ahead, the news isn't so great in the near term. And so it reminds me that when you consider different skills in the market, and I know we're going to talk a bit about metrics today and so on. I think one of the most important skills for investors to be thinking about and to master is this idea of patience, particularly in this type of marketplace. So we're going to get into obviously PE ratios and all these different things. But at the end of the day, I find that controlling emotion and staying steady in your strategy becomes really, really important. And it goes back to that Warren Buffett quote, right? Like the market is a method to transfer money from the impatient to the patient. And so I bring this up just because in listening today, from a theme standpoint, a lot of what I heard him talk about was recalibration, which to me means investors need to stay calm and be patient because they will ultimately be rewarded. And it's very contrary to how we really psychologically are wired, right? We're psychologically wired to act in these markets, to have that fight or flight sort of concept going on. And, even the media in these types of markets, the financial media, they're structured to trigger us to act. But I really think the key here is to be patient and really, truly try to stay calm and be disciplined. So that was the big theme that came through to me in listening to the interview. And obviously we can get more into that as we go on.
Yeah, I love that, Megan, and I think it brings up the fact that we're bringing back a lot of principles that people have ignored for like the last 10 years because it's been so easy. So I love that we're kind of bringing back good investing principles. Barb, what about you? What are some of your takeaways?
First of all, Megan, so true. And as someone who's been investing for decades, this happens. This is not a huge surprise. When the market becomes overvalued, which means people are paying more and more dollars for a small amount of earnings, at some point it's going to reverse. Now, the market was overvalued according to standard metrics, which for those of you who are just, basic investors, there's one metric you want to be aware of to understand when people talk about overvalued and undervalued. Typically, most investors are talking about the price earnings ratio, which is the price of either a stock or the price of the market in general, divided by their previous 12 months earnings. And the higher the number, the more expensive the market is. So on average, the S&P 500, well, the average of the S&P 500 is about, PE ratio is about 16. And we went up in 2019 to, oh my gosh, let's see. I'm looking at a chart, which of course nobody else can see. We went up to an average.
I'll put it up in the show, Barb.
Yeah. Yeah, Kirk will put it up in the show notes, the link, but we went up to nearly 60. Now the PE ratio is at 20, which means we're still above average. So just take a minute to grasp that. We're all crying that, oh, we lost so much money in our stock and bond portfolios this year. But first of all, in general, the stocks are still a little pricey according to historical norms. That's point one. And point two is compare not your return to your portfolio valuation from now to 2021, but compare it to 2019. You're up. Okay. So this is normal. This is healthy. And this is exactly what is supposed to happen. When markets get too frothy, they get too expensive. It's important for them to balance out. It's unreasonable to expect them to continually go up because businesses have market cycles. They go up, they go down. That's how they work. That is in their core principles. As is the same with the stock market. And if you don't understand that, if you can't tolerate that, then you shouldn't be in the stock market.
Yeah, so if I look at this 90-year PE ratio chart, you can look at the lows around May of 1949, and they were about 5.94, I think is what the low was. And you got a high in around 2008 of about 120. Now that was an anomaly for various reasons, so I would kind of ignore that for the most part. But I think the natural range is between 10 and 20, and right now we're at the high end of the range. We got up to close to 40 recently, but if you look at valuations, I think this is why I still think things are expensive. And while we did do a bit of predicting on the show, we have come out and talked a lot about year-end predictions and how terrible they are for your own kind of mental models, because nobody can predict the future, but we all try. So what are your thoughts on year-end projections, Megan?
It's so funny. I always joke this time of year with my colleagues, like, I wish I had one of those jobs where I could predict what's going to happen this year, as one of those, as a lot of the CIOs do. Because there's actually no accountability in making these projections. Nobody sort of says, wait a minute, you didn't get that right last year. So what I like to do, and I would suggest this to our listeners, that, a lot of times the big investment firms, their financial forecast for the year is eventually released. In the beginning, they hold it back for their clients, but then they release it. And I think it's always good to come up with sort of a one-page summary on where they think growth will be, where do they think the S&P 500 will end, all those different metrics, just to sort of get a sense of what they're seeing across the board. But again, that's just information to use as guideposts. And I think what's really, really important here is sticking to strategy. And he said something in the interview, and Kirk, I'm going to want to hear your point of view on this. But he talked about the fact, the past 10 years, it was sort of easy to make money, right? And we're going through this recalibration. And one of the things that, has been the debate over the past decade is this debate between indexing versus active management, right? And indexing sort of had its day for the past decade. And you saw firms spring up about it. And in particular, millennials and Gen Zers have sort of grown up with this idea that indexing is the best way to get access to the markets. And I think one of the things that's very striking over the past 2 years in particular, with everything that's going on in Russia, everything that's going on in China, and across Europe and the UK, right, is that maybe indexing is not always the best choice for every asset class. And so in these moments of recalibration, we talk a lot about an investment policy statement or having a mandate for your portfolio. And I've never believed that the 60-40 allocation is dead. But I do think in these moments when the markets recalibrate, we need to be thinking about, okay, the 60-40 might not be dead, but how do I make up my 60-40? And am I right to continue to index in every asset class? Or am I better served cherry picking certain asset classes that I have decided to do active management? For instance, Kirk, in the interview, I heard you talk about bonds, right? And not a good time to be in bonds, right? That might warrant someone to think about maybe adding a layer of active management there, or in the emerging market space to add some active management. And those are sometimes, I think, the subtle shifts when the market is recalibrating that can make a difference over the long term. But what I would really just sort of finish with is say, if you're going to make that subtle shift, if you're going to shift in a certain direction where certain things are indexed and certain things are active, put it in the mandate, because discipline is key, and it's key to also having patience. So I don't know what your thoughts are on that, Kirk, in terms of active versus passive as we recalibrate.
Yeah, look, it's a great question, Megan. I appreciate you kind of mentioning here. It's the way I kind of think about it is, for the last 20 years, I've been doing this for 24 years now. And I think the entire time, things have changed dramatically. And from the early 2000s to today, we had a great run for 20 years where the markets pretty much went up for most of the time. And this trend of passive investing and indexing has been extremely strong since 2008, because people just realized that it doesn't matter what they hold, the market's going to drop a similar amount, like what happened in 2008 and 2009. And so a lot of managers just started indexing or closet indexing, as we call them, where they would be quote unquote active, but really what they're trying to do is hug the index. And what's interesting about it is there are certain asset classes which historically are better to have active managers. High yield bonds, emerging markets, some international, but in some other types of bonds, high yield especially. But there are certain asset classes where if you have a good manager, it makes all the difference in the world. If you're buying an index fund, you're probably going to leave a lot on the table. And, worst case, it might even be harmful if things freeze up when the markets freeze up. So I think there is always a place for active managers. The strong trend going passive has been going for a while, and people just stopped thinking and they just said, oh, we're just going to be passive and we're going to index. And I think as Jeff mentioned, a lot of people are going to get harmed that way, because they're just going to think it's going to be fine to be passive, and they might lose 10 plus years of returns because they just decide to index, and the index doesn't go anywhere like it did in the 70s, like it did in the early 2000s. I think we're into another period like that where having good active managers is really important. And we're going to have to go back to figure out who the good active managers are, because for the last 10 years, most of them have been, kind of mailing it in by closet indexing. So I think the challenge is going to be steep for the individual investors to figure out who's good after the last 10 years when you can't really look at performance. You have to look beyond that. So I don't know, Barb, what are your thoughts on the active versus passive debate?
Well, there's a lot of data on that. I mean, there's reams of data, and over long periods of time. And that's all different than during short segments of 5-10 years. It's been very difficult for active managers to outperform passive. It just has, because one of the basic intuitive reasons and research-based reasons is because if you're paying a fund manager 75 basis points, 1%, and you're paying 4 basis points or 0.04% for a passively managed fund, the active fund manager literally has to make at least 1% more than the passive manager to outperform. That's a tough hurdle.
But hold on one second, Barbara. I just want to point out there real quick.
Yeah.
Not all, like I will tell you, in the high net worth, ultra high net worth space, people don't charge 1%, right?
No, but I'm talking about
in certain. I don't want to. I think it's a general assumption that it's 1% fee, but I will tell you, in certain spaces, it's not, and so it's not such a big hurdle.
No, but I'm talking about actively managed funds. And so, yeah, you'll get actively managed mutual funds from, or ETFs from, say, 50 basis points on up. So I'm not talking about like investment management fees. Okay. But those are actually on top of the fees you're going to pay a fund. So long-term research has been pretty clear that it's really tough to beat the indices. But I want to throw out another component of this. What if the markets what if they are flat? Well, there are some ballasts there, which is, let's assume that you are an indexer and you go with the research that over long periods of time, index fund investing has in general outperformed most active fund managers. You have a couple other components, which is you want to look at your asset allocation. You want to look at dividend yield. Okay, so stock market, let's say the stock market really kind of treads sideways for a while. You've still got a couple of % dividend that you can reinvest at these lower levels. Then if you're a diversified investor, as we're seeing now, bond yields are going up 4, 5, 6, 7% returns. Cash yields, you can get 4% on a short-term treasury bill. So it's not like you're stuck if you're a passive investor. Where you're stuck is if you're not diversified.
Yeah, and I think it kind of goes back to the point that was made earlier, is diversification is really important. In times like this, when we have these contagions, when everything sells off together, diversification doesn't help you, which I think a lot of people don't realize is what was going on for like the last 14 years. So I think one of the challenges is that has not been effective during those times, and I think we've all been conditioned that we're going to get that every single time because it's happened since 2008. We just get these capitulations, and I'm sorry, they're not the capitulations, but you get these contagions where everything sells off together, and the market falls off a cliff. We've all been conditioned that that's going to happen. It hasn't happened this year. Surprisingly, I would have thought in 2022 it would have happened. Maybe it'll happen this year. Maybe it won't. But what's interesting is that the markets are constantly changing, and owning bonds for like the last, 10 years has really not paid off. But because rates are going back up and you can get 4% plus on government bonds, it actually makes sense to start considering bonds for the portfolio. I wouldn't start adding them, like a 60-40 allocation right now, because the bonds should still go up, and which means you probably lose value. But that 4% does a lot to create a buffer for any sort of loss in a rise in bond yields. So the higher the yields go, and this is something that I think most investors don't realize, if you go from 0 to 1, there's an enormous loss of capital, of principal, If you go from 15 to 16%, there's a much smaller loss. So the higher you get in yields, the less of a loss you're going to get, and the bigger buffer you're going to get for the yield for offsetting that loss. So I think the attractive part about bonds is the higher they get, the less impact you're going to have on any sort of loss, because let's say you're at 15%, you get a 15% US Treasury. Who cares if it goes to 20? You're getting 15%. Now you might argue, well, I know, but inflation's high and all those things. But the reality is, if you're getting 15%, that's a lot. And there's a lot of buffer there that can protect you from any further losses to the upside. Whereas going from 0 to 1, it's hard to recover 22% loss in principal from that bond. So I just wanted to point that out, because a lot of people don't understand bonds because they just buy funds. And they don't really buy the individual bonds, which is really hard for individual investors to wrap their mind around. So I just wanted to point that out. And it does make sense to start looking at them, to start adding them to your portfolio. But I would definitely be patient with them, because if the Federal Reserve is being truthful with us, which they don't always do, but if they are, which at this point I believe they are, then rates are going to continue to go up for a little bit. So something to keep in mind. Barb, you wanted to comment on that?
I wanted to just have one more point about asset allocation. What I have seen over the past 10, 15 years is the models for asset allocation, especially for aggressive or less conservative investors and younger investors, were kind of mind-boggling to me. And what I mean by that is, I saw a lot of modeling that said, if you're 30, 35, and you've got a whole lot of years ahead of you, given that the stock market has outperformed all other asset classes in general, or should I say stocks and bonds and cash, that younger investors should be invested 90% in stocks. Well, that would have been awesome up until last year. And so, do you want to create a portfolio that's going to kind of get you through different market scenarios, or do you want to be an active investor and switch it up? Because I would just say that most people are not active investors. And so even if you're 30 and you're now, having been a 90% stock owner or 100% stock market owner, you're seeing what happens when there's a reversal. And so I make the case of, regardless of how old you are, regardless of how aggressive you think you are, if you're getting a little upset by seeing your portfolio drop 20%, 25%, maybe you should always have a little bit of cash and or bonds in there to, well, of course, bonds didn't do too well last year, but they, in general, in most cases, will even out the declines of a stock market.
Yeah, I mean, I'm all for asset allocation the right way. And I think we all have to re-look at the model of asset allocation. I'll give you an example. So for the last 5 years, maybe 3 to 5 years, I've been having conversations with people, and especially people who are close to retirement, new prospective clients would come in and say, oh, I've got this portfolio. They're 65 years old, and it's like 80-20 or 90-10. And I'm just shaking my head thinking, like, what's going on? But at the same time, while that might be ridiculous if you look at it from like a 20 or 40-year period, you say that's really ridiculous and dangerous. However, at the time, if you're getting 0% on bonds and you have a high probability of losing money and a low probability of making money, and stocks were the better bet, even though there was more risk to them. So I think what's challenging is we all look at asset allocation, and we look at things at a point in time, or we take 40 years of time and compress it into one point, and we assume this is the way it's going to be, as opposed to looking at it and saying there's a broad spectrum of time here and situations, right? If interest rates are 0, putting all your money in bonds is probably not a good idea. Just like if stocks are at, 50-year highs and they're overvalued more than they've ever been in history, probably not the best time to put all your money in stocks, right? Like, you can look at the extremes and say, all right, there's something missing here that needs to be adjusted. And some of it is just your perspective in time. And I think what a lot of people don't do is they don't bring that perspective to investing, to allocate according to valuations as well as risk. So I just want to bring that out. But let's kind of move into another topic here, which I think is also really important, which is how to value stocks, looking at metrics. And we talked a little bit about on the interview, but as we've gone from a passive indexing kind of mentality to hopefully a more active, mindful of valuation, fundamental based environment, people need to learn how to do that again. Professional portfolio managers, individuals got really lazy because it was easy just to buy FANG stocks and hold your nose and buy as they kept going up. But when you do that for a long time, you get lazy and you think, oh, it's easy, I can just do that. But now you actually have to do the work. You have to value a stock. You have to figure it out how they are relative. So, Megan, when we get into this new environment, like, how would you look at that? Like, how would you advise people and based on, this new kind of theme going on in the markets?
This might be a boring answer, but my firm isn't stock picking, right? So we do due diligence on managers that meet our clients' needs in certain asset classes. So it's much more about sticking to asset allocation and determining what asset classes, you're underexposed in and which ones you're overexposed in and how to deploy. I think for clients with new money on the sidelines, I think the debate becomes, doing something incredibly boring, which is dollar cost averaging into the market. And I know he talked about it on the interview, people buying when it's high, buying when it's low, buying all the time. But I think ultimately it's one of those methods that sort of helps alleviate anxiety on entering the market. And I think the other thing I'll say is the market recalibrates, going through each asset class and making sure you're finding the right opportunities in each asset class, right? Different opportunities are going to spring up over time, and you're going to want to take advantage of that. So again, I know it's a boring answer, but it's the best investing often is boring.
Well, as they say, investing shouldn't be fun. It shouldn't be exciting. If it is, you're doing it wrong. So I totally agree. Barb, you're former portfolio manager. I know you have a lot of history with fundamental analysis and value-based investing. So what are your thoughts going into this new paradigm? How would you, what should people be looking for in metrics, and how should they be looking at their investments?
If you want to be a stock picker, that is different than buying ETFs, mutual funds, actively managed, which means the manager picks the investments, or passively managed, which means you are buying, in essence, the market, either the S&P 500, small cap, large cap, whatever. That's one sphere of investing. But Kirk asked me, what about stock pickers? Do you want to pick individual stocks? And if you do, there's a chance, a probability that if you do a lot of research, you will find either undervalued stocks. And when I say undervalued, that means you have to learn. Stock analysis is a skill. And I'm talking about fundamental investing, which is different than technical investing, which typically looks at broader market indicators. Is the stock going up? If it's going up, if it's above or below their 200-day moving average, should you buy or should you sell? That's one aspect. Fundamental analysis looks at the balance sheet of the company, looks at the earnings growth, looks at the cash flow, looks at the relationship, as I talked about in the beginning, between price and earnings. And is it reasonably priced? Is it reasonably priced in contrast with the industry, with the company's history? And this is a discipline that takes a little bit of time to learn. If you're interested in this, the American Association of Independent Investment Corporations, or the NAIC, are two nonprofits that will teach you these skills. And I'm not going to say don't do it, because it's very interesting and you have a probability to make very large gains. But don't do it and invest in one stock. If you're going to go into individual stock investing, you have to own at least 10 stocks to make sure that the majority of them are going to go up, because some of them will obviously go down.
Yeah. So as we kind of get close to wrapping it up here, I want to get some final thoughts from you, Megan, and kind of maybe some final pointers of how people can navigate this market successfully.
Yeah. And, going back to what I started with, as the markets recalibrate, patience is needed. Staying calm in these situations, understanding this in the long term is going to be just a blip, and really thinking through what your discipline is, right? Don't let the noise around you move away from how you should be behaving in this type of marketplace. And I think as we recalibrate, take a look at your investment policy statement, your mandate, and make sure that it still matches what your overarching strategy is. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, thanks for having me on.
Thanks for coming on, Megan. And Barb, final thoughts from you and final thoughts from how people can navigate.
Well, remember, investing is not a game. It's not throwing darts at a stock list. It is a way to take the earnings that you have today, deploy them into companies in the US and abroad, either lending money or buying equity in the company. And then hopefully that money will grow along with those businesses. So it is a discipline. It's a means to an end of having greater wealth at a later date. So be aware of why you're investing, what you're investing in, the characteristics of those investments. And I am Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance. Thanks
for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.